Welcome to PPP Loan Forgiveness Application Review. PPP loan forgiveness applications are an ever-evolving process. The SBA and Treasury Department are continually releasing new guidance, and the information that I'm going to present today is subject to change at any time. Your judgment and interpretations may also be necessary. I'm Jonna Kelly, and I'm an advisory manager here at Briggs & Veselka. On July 3rd, President Trump signed into law an extension of the deadline to allow further borrowing for PPP loans. The extension was to August 8th. At that time, an estimated $130 billion of the $659 billion originally approved by Congress was still available. On July 6th, the U.S. Treasury Department released the names of roughly 660,000 companies that borrowed funds from the SBA PPP loan program. The report estimated that 15% of the 5 million small businesses participating borrowed over $150,000. Now that Congress has reconvened, negotiations are going to resume to determine what may be included in the next round of the stimulus package. Our goal at Briggs & Veselka is to interact with borrowers appropriately as they navigate through the forgiveness application, to assist borrowers in understanding the forgiveness applications and the related SBA guidance, to provide guidance to the borrowers so that the forgiveness application inputs are calculated correctly and have adequate support, and to support borrowers as they navigate the forgiveness process. There are several areas of potential confusion. Borrowers are ultimately responsible for the application, and you're going to want to fully understand the different aspects of the forgiveness process. Some of these aspects may include: what is covered period? What is the alternate covered period? Which application should I submit? How do I calculate a safe harbor for the full-time equivalents? Or the safe harbor for a salary or hourly wage reduction? What can be included in an owner's compensation? And what documents should I supply when I make my application? And what should I keep on file? Borrowers are permitted to submit their application when they have used all of their funds. Potential reduction is based on full-time equivalent and the salary wage calculations as of the date of the application. Since most banks are not accepting applications yet, there's been a lot of confusion about what the date of the application may be. In our conversations with lenders, we've learned that they interpret the guidance to state that when a borrower has run out of money and used all of their funds, that is the end of their covered period, and then that can be considered when a reduction or a safe harbor is calculated. Borrowers can choose the 8-week covered period if they received their loan prior to June 5th, 2020, or they can extend the covered period to up to 24 weeks. This does not mean that a borrower has to use the full 24 weeks, but as stated above, the period will end when the use of the funds is completed. It's important to remember that PPP documentation must be maintained for at least 6 years after the date the loan is forgiven or the loan is paid in full. The SBA and the SBA Inspector General must be granted those files upon request. Once the receipt of the application for forgiveness is given to the lender has 60 days to approve forgiveness. And once the lender determines that the borrower is entitled to some or all of the loan forgiven, they will request payment from the SBA. The SBA then has 90 days to review what the lender has determined and remit the appropriate amount of forgiveness to the lender, plus any interest accrued through the date of payment. One interesting thing we've heard from our lenders is that the SBA portal to submit the applications after the lender has agreed with the forgiveness calculation is not open yet, which may cause some delay in the ability to apply for forgiveness. If the SBA determines during the review that the borrower was somehow ineligible for the loan based on the rules or guidance that was available at the time, or due to inadequate basis for the certifications made at the time of the application, the loan will not be eligible for forgiveness. Originally, the application that came out was 11 pages, but it has since been revised. On June 17th, 2 new applications were released. One is the Form 3508, and the other is the simpler 3-page Form 3508EZ, That's only applicable to certain borrowers. We'll take a closer look at these. Starting with the 3508EZ, only certain borrowers are allowed to use this application. A borrower must have at least one of the following situations to be eligible. They may be, first, self-employed, an independent contractor, or sole proprietor who do not have any employee salaries in their computation of payroll. If that situation doesn't apply, a borrower could still use this application if they did not reduce their salary or hourly wages by more than 25% during the covered period or alternate covered period as compared to the period between January 1st and March 31st. And as well, the borrower could not have reduced the number of employees or the average paid hours of employees between January 1st, 2020 and all the way to the end of the covered period. So no reduction during that entire time frame. If neither of those two apply, the third option would be that the borrower does not reduce the annual salary or hourly wages by more than 25% as stated above, and the borrower was somehow unable to operate at the same level of activity as before February 15th due to regulatory requirements. And we'll talk in greater detail about what that might entail. It's important to start thinking about the documents that you'll want to submit with your application and that you'll want to keep on file. When a borrower uses the 3508EZ, they will need to submit the following information. They'll need to provide the amount of payroll cost and non-payroll costs, such as mortgage interest, rent, lease payments, and utilities. They'll need to provide documentation that verifies the payroll cost. The documentation that should be submitted are the following: bank statements or a payroll service provider report, tax forms, such as the Form 941 for the periods that overlap with the covered or alternate covered period. Let's hesitate here because that's a really important point. If you're still using your PPP funds in July or August, then the tax form that you'll need to supply will be both quarter 2 Form 941 and quarter 3 Form 941, which will not be available until October. This could cause a delay in submitting the application for forgiveness. In addition, the borrower will need to provide receipts, canceled checks, or account statements that verify the employer retirement or health insurance contributions. And they'll need to provide their calculation of the average full-time equivalents on January 1st and the end of the covered period. To verify non-payroll cost, documents would be a copy of the lender amortization schedule, account statements or canceled checks that verify eligible mortgage interest payments during the covered period, a copy of current lease agreement and receipts or canceled checks that verify lease or rent payments during the covered period, and copy of invoices and receipts, canceled checks, or account statements that verify utility payments during the covered period. All of these need to be submitted with the application. Items that do not need to be submitted but do need to be kept on file would be documents to support the claim that the wages were not reduced more than 25%. That must include each employee and amount, a very detailed calculation. Secondly, documentation that supports job offers, refusals, firing for cause, voluntary resignations, and written request by an employee for a reduction in the work schedule. These situations allow a borrower to not count those people against their full-time equivalent. So we would need documentation to be kept on file to substantiate that the reason that that employee is no longer working for the entity was for a situation such as a voluntary resignation. In addition, document to support the claim that the borrower did not reduce the number of employees or the average paid hour of employees between January 1st and the end of the covered period. And lastly, documentation that supports, if this is applicable, that the borrower was not able to operate at the same activity level due to regulatory compliance. The regulatory compliance illustrated in the application instructions are entities such as the Secretary of Health and Human Resources, Director of the CDC, OSHA, or any other work or customer safety requirement related to COVID. Let's take a look at the Form 3508. The 3508 contains the following parts: the actual loan forgiveness calculation form where payroll and non-payroll is recorded, and any adjustments for reductions, and a final forgiveness amount. A Schedule A that calculates the total payroll costs. A Schedule A worksheet that calculates full-time equivalents and any salary or hourly wage reduction, as well as a potential safe harbor calculation. And then an optional demographic information form. Only the first two are actually submitted to the lender. The Schedule A worksheet is just a calculation form, and many borrowers may choose to use something like an Excel to support their Schedule A. Some of the same documentation needs to be provided when verifying payroll costs. Again, we would need either the bank statements to show the payments of payroll, or probably more simply, a payroll provider report, such as an ADP, Paychex, or Gusto report. Secondly, the same tax forms we listed earlier, the Form 941s, for any periods that overlap the covered period or alternate covered period. Receipts or canceled checks, anything that would verify the health insurance or retirement contributions. And then fourth, the documentation such as payroll tax reports or a TWC report that would verify the average full-time equivalents that's reported on Schedule A. It would need to calculate the average number of full-time equivalent employees per month between February 15th, 2019 and June 30th, 2019. The average number of full-time equivalent employees per month between January 1st, 2020 and February 29th, 2020. And then for seasonal employers, the average number of full-time employees on the payroll per month between February 15th, 2019 and June 30th, 2019, between January 1st, 2020 and February 29th, 2020, or any consecutive 12-week period between May 1st, 2019 and September 15th, 2019. Further, for the non-payroll cost, documents should verify the existence of the obligations prior to February 15th, 2020. So for example, a rental agreement that was only put in place in April would not be eligible for forgiveness. The rental agreement needs to be in place prior to February 15th, 2020. So again, you would need to submit the documentation to prove the interest payments on loans, rent and lease payments, and utility payments. Documents not submitted but maintained would be, again, the Schedule A worksheet, documentation that supports the listing of each individual employee that's on Table 1 of the Schedule A worksheet, including any salary or hourly wage reduction calculation. Similar documentation for everyone in Table 2. We'll look a little bit closer at those two tables in a moment, where these are where the employees that make over $100,000 will be included. Documentation to report the job offers, refusals, and etc. that are a part of the calculation, and documentation to support the full-time equivalent reduction safe harbor, if any. It's important to make a decision about the covered period, and there's a lot of moving parts to consider in that case. With the covered period extension from 8 weeks to up to 24 weeks and the new 60% payroll cost limitation, borrowers have much greater flexibility in the use of their PPP funds, but they're going to want to consider what the best option is for their particular situation. Only borrowers that pay biweekly or more frequently, so either every 2 weeks or more frequently, are eligible for the alternate covered period. Those that are eligible are allowed to start their covered period on the day of their first pay period. In other words, if they received a loan on April 23rd, but their first pay period started on May 1st, for ease of computation, they could start their alternate covered period if they would like on May 1st. The interim final rule issued by the SBA that became effective on June 5th states that if a borrower applies for forgiveness before the end of the covered period and has reduced an employee's salaries or wages by more than 25%, the borrower must account for the salary reduction for the full 8 or 24-week covered period. So in other words, let's say a borrower would like to use a covered period that's 12 weeks. They've used up all the money, their covered period is over, and as of that 12th week, they've reduced their wages by 30%. That reduction does not just apply for each week of the covered period of 12 weeks, but will actually be projected out the full 24 weeks. So it's very important to consider any kind of salary or wage reduction that's more than 25% because it has a very long-lasting calculation. And lastly, payroll costs that are paid or incurred during the covered period are eligible for forgiveness. And that's important to remember because even if the pay actually takes place a couple of days after your covered period, if they were incurred during the covered period, they can be included for forgiveness. And borrowers will want to carefully illustrate that those are the costs that they are calculating. There are some employer tax deferrals, tax credits, and such that may interact with PPP loans. The Family First Coronavirus Response Act, or FFCRA, credit reimburses an employer who has paid sick or family leave wages, and an employer is not subject to the portion of Social Security tax on these wages. The borrower can take that credit while they have a PPP loan, but they're not allowed to use those costs in their application for forgiveness. So in other words, they can't be double dipped. Originally, payroll tax deferral was not allowed for borrowers that had PPP loans, but that has been changed from the original guidance, and now PPP loan borrowers are allowed to make a deferral of payroll tax through December 31st, 2020. The employee retention credit is not eligible to be taken at the same time as a PPP loan. In fact, guidance stated that employers would need to return their PPP loans by May 14th if they wanted to take the employee retention credit. There are many safe harbors to consider. The salary and hourly wage reduction safe harbor will be the first one we'll discuss. Borrowers are going to compare the average annual salary or hourly wage for employees on Table 1 of the Schedule A worksheet. To calculate any potential safe harbor, the borrower will calculate the following. First, they'll consider the annual salary or hourly wage on February 15th of 2020. Second, they're going to calculate that same calculation for the wages between the 15th of February and April 26th, so any payroll that covers those timeframes. And then lastly, the borrower will calculate the annual salary or hourly wages as of either December 31st or the date the application is submitted when the funds are used up. If the first calculation in number 1 is greater than number 2, so in other words, the wages went down between February 15th and 26th, and then number 3 is greater than or equal to number 1, so wages went back up to the February 15th rate or increased beyond that rate, then the safe harbor has been met. If number 2 is greater than number 1, so in other words, if salaries were at a certain level on February 15th, then went up between February 15th and 26th, April 26th, then the borrower is not eligible for this safe harbor. The next calculation that's important to consider is the full-time equivalent. Earlier guidance illustrated exactly how a borrower should calculate their full-time equivalents. To calculate the total full-time equivalent, a borrower needs to enter the average number of hours paid per week per employee and then divide by 40. At that point, there's two options. Either the borrower can take approach 1 and round that number to the nearest 10th place, or the borrower can make each person below 40 or below 1 after dividing by 40. They can make them equivalent to 0.5. And everyone that's 1 or above just stays at 1. You can see on this graphic that the amount will be calculated differently based on the approach. It may seem clear that you get a higher number or a lower number using a certain approach, but remember that this same approach must be used for all calculations and therefore may turn out to be fairly equivalent. The Safe Harbor 1 for full-time reductions is a very important one to consider. If a borrower has this situation, they would be exempt from the reduction in loan forgiveness. If they were unable to operate between February 15th and the end of the covered period at the same level of business activity as they were before February 15th, specifically due to guidance issued between March 1st and December 31st by either the Secretary of Health and Human Services, the Director of the Centers for Disease Control and Prevention, or Occupational Safety and Health Administration related to sanitation standards, social distancing, or any other worker or customer safety requirement related to COVID-19, then they would be eligible for Safe Harbor 1. This is primarily for entities such as restaurants who maybe were not allowed to have more than 25% capacity, and so therefore were unable to operate between those levels. It's important to remember here that these safe harbors have very specific requirements. For instance, in this case, that is related to specific guidance issued between specific dates. Safe Harbor 2. Another safe harbor that eligible borrowers may take is if their full-time level changes between certain reference periods and the end of their covered period. There's 2 reference periods to consider. The first one is to calculate the total average full-time equivalent for the pay periods inclusive of February 15th, 2020 and April 26, 2020. The second reference period requires a calculation of the total full-time equivalents on February 15th, 2020. If reference period 2 is greater than reference period 1, and the borrower returns full-time equivalents by either December 31st or the date the application is submitted, then the full-time equivalent reduction safe harbor has been satisfied. This is similar to the safe harbor for salary and hourly wage reductions. Otherwise, if they're not eligible for either of these safe harbors, the borrower must complete the PPP Schedule A, line 13, by dividing line 12 by line 11 and figuring out their quotient for the reduction in forgiveness. Let's talk about that in greater detail. When no safe harbor is applied, there are a few calculations that are necessary. First of all, a borrower will enter the total average weekly full-time equivalents during their chosen reference period, either between February 15th, 2019 and June 30th, 2019, or January 1st, 2020, or February 29th, 2020. This is a choice. You can use whichever reference period is to the advantage of the borrower. Then on worksheet table 1, where the full-time equivalent is calculated, that will be added to the full-time equivalent for table 2, and the sum of both of those will be entered on line 12. So we'll have a number on line 11 and number on line 12 of Schedule A. These two will be divided, line 12 by line 11, to get the full-time equivalent reduction quotient. That's part of the ending calculation for what is ultimately forgiven. Here's just a quick snapshot of the tables I was referencing earlier. Table 1 and Table 2 are part of the Schedule A worksheet. Again, this worksheet is not submitted, but it is required to be maintained. For most borrowers, they may find that this worksheet is not long enough, and they may do all of this calculation on an Excel, which is perfectly approved. On Table 1, this is for the employees that are below 100,000, so less than or equal to 100,000 for all pay periods in 2019, or were not employed by the borrower at some point in 2019. So that goes in Table 1. Table 2 is for employees that the borrower paid more than 100,000 for any pay period in 2019. So anyone that had an annualized rate of more than 100,000 should be on Table 2, even if they were not employed for that full time. You'll notice that in these two tables, there's a difference in that the salary and hourly wage reduction is not a part of Table 2, and that's because borrowers that make 100,000 or more annualized are not considered in that reduction. So we'll turn our attention to some non-payroll cost. It's important to keep in mind that here again, paid or incurred is the phrase to keep in mind. Anything paid or incurred during the covered period and that is paid on or before the next regular billing date, even if that's outside of the covered period, can be eligible for forgiveness. So for example, many people pay in May their April utilities, and during May they are also incurring utilities. Both of these costs during the month of May are eligible for forgiveness. Business mortgage interest payments are also eligible for forgiveness. The original Section 1102 of the CARES Act indicated that any interest on any other debt obligations that were incurred would be eligible, which has led to lots of questions such as, can I include my line of credit interest? There's some guidance needed in that area, and the questions are still remaining. Business rent or lease payments for any lease agreement that's in place before February 15th, 2020, and utility payments for service that is before February 15th, 2020. We've received a lot of questions regarding what actually entails transportation. Generally, it is thought to be transportation in the course of business that is part of the operating expense of the entity. Owner compensation was definitely elaborated upon in the most recent guidance. It's important that borrowers consider what type of tax structure they are when making decisions about what they're going to include in terms of owner compensation. We've divided this chart into different columns, the first being for someone that is choosing the 8-week forgiveness period, the second column for anyone that is choosing up to 24 weeks, and then in the last column, what benefits may be included. Borrowers will notice that Schedule C, Schedule Fs, and partnerships don't include any benefits in their calculation for forgiveness. However, a C Corp would include health insurance and retirement. The most important thing I want to point out here is that borrowers are limited in their owner compensation. 2019 compensation must be considered for owners, whereas it is not considered for a regular employee. And what that means is that, for example, an S-Corp shareholder that may have made a certain amount of money in 2019 and now has a covered period of perhaps 12 weeks would be using column 2. And their limitation would be the lesser of 2.5 over 12, or 20.83% of the borrower's 2019 compensation, or $20,833. What's clear here is that the SBA and Treasury Department is limiting owners to 10 weeks of their 2019 compensation. So the same amount that was used to create the application for the PPP loan is a limit now on the owners. This is not for all employees, but for the owners. So even though an S-Corp shareholder that maybe uses an entire 24 weeks for the rest of their employees and will limit them to an annualized salary of $100,000, the S-Corp shareholder himself can only use 10 weeks of that 100,000 or 20,833. Furthermore, owners are always limited to their 2019 compensation. Therefore, an owner who made $48,000 for 6 months would be limited to $10,000 of forgivable expense. That's calculated by estimating the $4,000 per month, multiplying that times 2.5 months, but then dividing by 2 because they only worked for half the year. More about owner's compensation. The guidance suggests that retirement contributions that are paid or incurred during forgiveness can be counted. We've already discussed that briefly. This would mean that any retirement contributions that were incurred in 2019 but paid in 2020 during the covered period, as well as any retirement contributions incurred in 2020 during the covered period but paid in 2021, would be eligible. However, verbiage from the EZ application appears to limit the contribution on behalf of the owner to 2.5 months of the 2019 contribution. The verbiage is listed here. It states, do not add employer contributions made on behalf of a self-employed individual or general partners, because such payments are already included in their compensation. And furthermore, contributions on behalf of owner employees are capped at 2.5 months worth of the 2019 contribution amount. So while for your regular employees, you can include 2019 retirement contributions that were incurred but not paid till your covered period, and the 2020 contributions that are incurred, that would not be the case for owners. It is unclear, however, why this verbiage is included in the EZ application, but not in the 3508 itself. The assumption is that that was an oversight. Lastly, there have been many questions about who is considered an owner-employee. There is no specific limitation, so we're going to assume that anyone who has an ownership interest in an entity would be considered an owner-employee, no matter how small the interest might be. As everyone has likely heard, loans in excess of $2 million are subject to automatic review following a lender's submission of forgiveness. And that's true for up to 6 years. But borrowers will want to remember that all borrowers have the potential to be reviewed. Taxpayer concerns that we've heard in the news about how PPP funds are being used may create an environment where lawmakers are pressured to review more loans. It's important to think of the necessity of the loan, to be able to create a documentation trail that shows financial stress, access to capital that does not inadvertently hurt the business. What kind of liquidity was the situation? In addition, what kind of calculation of payroll costs were used to determine the loan amount originally when the application for the actual loan was submitted? How were the proceeds used? What kind of forgiveness adjustments were taken, and were they properly calculated? Good faith certification is necessary. We've quoted here, current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. We've received quite a few questions about this because at the time of the application, there was quite a bit of uncertainty going forward, and perhaps what ended up happening was not what the borrower originally anticipated. Borrowers must make this certification in good faith, taking into account that their current business activity and their ability to access other sources of liquidity that were sufficient to support their operations was not detrimental to the business. That good faith certification originally made would be important to document. It's also important to note that unnecessary borrowing through the PPP loan may carry criminal consequences, such as a $1 million fine or up to 30 years in prison. How does a business define necessary in the context of the most unprecedented health and economic crisis of our lifetime? Well, a borrower must determine the impact that COVID had on the revenues and expenses, again, the liquidity and access to other capital resources, what kind of key employees may have contracted COVID-19, and what kind of economic hardship do they anticipate coming ahead? We're certainly not at the end of this road. Let's end by talking about some things that are on the horizon. Last month, 2 bank lobbying organizations made a request that Congress automatically forgive PPP loans of $150,000 or less, and this idea is really gaining some support. Of course, lobbyists are always out there looking for ways to push the request of their organizations, but bankers are really just trying to limit the need for small borrowers to go through such long calculations for their forgiveness applications. Because of this, a bipartisan bill was introduced in the Senate that would forgive all these loans, but it does require a one-page form to be submitted. The borrower would have to attest on the form that the loan is eligible for forgiveness, therefore that they can claim that all of the things we've discussed earlier are in fact their case, and that the business is in compliance with the PPP program requirements as found in the CARES Act. So that would be an attestation form that would need to be submitted. Concerns over fraud are looming. There's always a news story about what use of the PPP funds someone has discovered. This is causing some unease among members of Congress, particularly during an election year. The concern that the program may not actually have saved jobs may lead to hesitation in easing of any forgiveness requirements. There was a boost given to lawmakers when Secretary Mnuchin actually suggested that an automatic forgiveness for smaller loans be considered, and he also supports an extension of the PPP loan, but wants to target small companies in certain industries such as restaurants, hotels, and the travel hospitality industry. I hope that you have found this webinar to be helpful. We've utilized various resources in compiling this information such as the SBA and Department of Treasury websites and resources, bankers and lenders, and the AICPA. If you have any further questions, please feel free to email us at sbaassistance@bvccpa.com. Thank you.